Welcome to part 3 of our income tax guide, focusing on Medicare and tax offsets. Let's start by clarifying a fundamental concept: the difference between a deduction and a tax offset. A deduction reduces your overall taxable income. The actual cash you save depends on your marginal tax bracket. A $1,000 deduction might save a high-income earner $470, but save a lower-income earner much less. A tax offset, however, reduces your calculated tax payable on a dollar-for-dollar basis. Most tax offsets are non-refundable. This means they can reduce your income tax to zero, but they cannot be used to reduce your Medicare levy, nor will they generate a refund for any excess offset amount. However, some specific offsets, like the private health insurance tax offset, are refundable and can reduce your Medicare levy and boost your final refund. There are several standard non-refundable offsets that the ATO calculates automatically. First is the low-income tax offset, or LITO. For 2025, resident taxpayers earning up to $37,500 receive the maximum LITO of $700. This reduces gradually for incomes between $37,501 and $66,666. The formula for incomes between $37,501 and $45,000 is $700, taxable income minus $37,500, times 0.05. Next is the beneficiary tax offset. This applies to taxable Centrelink benefits, ensuring that taxpayers generally pay no tax on their benefit income. The offset applies to benefit amounts exceeding $6,000 using a specific 15% formula. Finally, the lump sum tax offset ensures that tax on eligible lump sum payments, like leave accrued before August 1993 or genuine redundancies, is capped at a maximum rate of 30%. If a client's marginal rate is higher than 30%, this offset steps in to reduce the tax on that specific lump sum down to the 30% cap. The Seniors and Pensioners Tax Offset, or SAPTO, is a highly valuable non-refundable offset. To qualify, a taxpayer must meet the qualifying age for the age pension, which is 67 from 1 July 2023, or qualify under the Veterans Entitlements Act. Crucially, they do not actually need to be receiving the pension to claim SAPTO, they just need to meet the age and residency requirements. SAPTO eligibility is tested against rebate income. Rebate income isn't just taxable income, it adds back things like net rental and investment losses, reportable supercontributions, and adjusted fringe benefits. For 2025, a single taxpayer gets a maximum offset of $2,230 if their rebate income is under $34,919. If they earn over that, the offset reduces by 12.5 cents for every dollar over the threshold, which we calculate by dividing the excess income by 8. If a taxpayer is part of a couple, and one spouse's income is very low, the higher-earning spouse might be entitled to a transfer of the unused portion of their partner's SAPTO. Most Australian residents pay a Medicare levy of 2% on their taxable income. Unlike income tax, there is no rounding to the nearest dollar here. However, there is relief for low-income earners via the Medicare levy reduction. For 2025, a single taxpayer earning $27,222 or less pays no Medicare levy. If they earn between $27,223 and $34,027, the levy shades in at a rate of 10% on the amount over the lower threshold. There are also family reductions. If a couple's combined taxable income is below $45,907, plus an extra $4,216 for every dependent child, they are exempt. Finally, seniors eligible for SAPTO get a much higher individual threshold, they pay no levy if they earn $43,020 or less. While a reduction is based on low income, an exemption from the Medicare levy is based on specific circumstances. There are 3 categories of prescribed persons. Category 1 covers medical exemptions, Defense Force members, VA Gold Card holders, and blind pensioners. Category 2 covers foreign residents. Category 3 covers people not entitled to Medicare benefits, usually temporary visa holders. To claim Category 3, the client absolutely must have a Medicare entitlement statement from Services Australia. A critical rule: if a prescribed person has dependents, like a spouse or children, who are not in an exemption category and have to pay the levy, the prescribed person may only be entitled to a half exemption. We report full exemption days at label V, and half exemption days at label W on the tax return. The Medicare levy surcharge, MLS, is a penalty tax of 1% to 1.5% designed to push high-income earners into the private hospital system. To see if a client gets hit with this surcharge, we don't just look at taxable income, we look at income for surcharge purposes. This adds back reportable fringe benefits, reportable super, deductible personal super, and net investment and rental losses. For 2025, a single person is liable if this income exceeds $97,000 and they don't have hospital cover. For a family, the threshold is $194,000, increasing by $1,500 for every child after the first. A crucial trap to watch for: if a taxpayer has private hospital cover, but their spouse or dependent children do not, the taxpayer is still liable for the surcharge. This includes children from a previous relationship for whom the taxpayer pays child support. If your client does hold appropriate private health insurance, they may be entitled to the private health insurance tax offset. This offset is refundable and is income tested based on the same income for surcharge purposes we just discussed. The percentage of the rebate depends on the age of the oldest person on the policy and the family's income tier, base, Tier 1, Tier 2, or Tier 3. Because the government historically adjusts the rebate percentages on the 1st of April every year, the health fund statement will usually split the premiums into two periods, the 1st of July to the 31st of March, and the 1st of April to the 30th of June. You must enter these exactly as they appear on the statement using the specific benefit codes provided. We also use specific claim codes. For example, Code C means a partnered taxpayer is claiming their own share, Code D means they are claiming their spouse's share as well, and Code E means the spouse is claiming it on their behalf. Finally, completing the spouse details section accurately is non-negotiable. If a client had a spouse at any point during the year, their details must be included. The ATO uses the spouse's taxable income and target foreign income to accurately calculate family Medicare levy reductions, the Medicare levy surcharge thresholds, and any SAPTO transfer entitlements. Once all of this is entered, the final tax calculation occurs. We start with the tax on taxable income, subtract our non-refundable offsets, like LITO and SAPTO, add the 2% Medicare levy and any Medicare levy surcharge, and finally subtract our refundable offsets and tax credits, such as PAYG withholding and franking credits. The result is your client's final tax refund or amount payable.